So, everyone, Mish, everyone, most of you all know him. Mish is the reason why we're here for a lot of reasons, but mostly because he was the motivation and the inspiration behind last year's conference, and really carried the torch over to this year. And so we're going to try to keep the torch going with Mish's presentation, and we'll follow it up with the Q&A and then the panel. So without further ado, Mish.
It's a pleasure to be back here. I get to speak last, actually. It puts a lot of pressure on me because we've seen a lot of great presentations. So I hope mine lives up to the quality of those that went before me. I'm going to talk about misconceptions, misperceptions, and blind spots. There's certainly a lot of them out there. I've had my share of them, and probably everyone else has too. I'm going to talk about valuation, about sentiment, about housing, and about demographics. Now, we've already heard a lot about valuation. We've not heard much about housing, although Stephanie talked about it, and we've really not heard much about demographics. So this is going to be a little bit different than the rest of them. The Tobin Q Ratio is it's a method of estimating the fair value of a stock market. It was developed by James Tobin. It's easy to explain. It's hard to do, actually. It's the total price of the stock market divided by the replacement value of the companies. And here's a chart. I got this from Doug Short, actually, at Advisor Perspectives. There's 4 charts in here, I think, that are his. And the data just comes from the Federal Reserve Z1. So even though the calculation is relatively hard to do, the Fed actually does it for you. And so, you know, we can see where we are here. We're at one of the all-time highs in history, dating back to 1900 for stock market valuation. The only one that was higher was the stock market bubble in 2000. Yet everyone compares this. You see it all the time. Well, stocks are cheap compared to 2000. Well, okay, does that make stocks cheap? No, it doesn't, because it's the second most expensive market of all times. And that's on an arithmetic means. And there's other ways of looking at this. This is the Q ratio, a percent change from geometric mean. And, you know, on this basis, we also see, whether we look at this arithmetically or geometrically, however we average this, and there's various ways of doing this, but they all say the same thing. So in terms of sentiment, this chart came from Sentiment Trader. They have some really excellent charts that they put out. They allowed me to use this one. Sentiment Trader is estimating that we're right here. This is actually a model of what the stock market did and looked like in 1966, and they're saying, well, we're right about here. Now, actually, last year I thought we were right about there, and I was right about there wrong, because the market went up almost another 30%. So when you make predictions, you're going to get some of them wrong if you make enough predictions. So I thought I did pretty good in 2007. I called the top of the stock market within a couple %, called the housing market top in 2005. Well, I tried to do it again last year here at this conference. I said, you know, we're peaking. Well, we didn't. And so I looked pretty foolish. Steen seems to think we're about here, but you know, maybe we follow this pattern, or maybe we don't. And Sentiment Trader certainly says we're not going to follow this exact pattern, and we're not. We're going to do something different. But is it really going to look like this? Well, maybe it looks like that, or maybe it looks like that with one more uprise. We're all guessing, but I'm not guessing about valuation. But it doesn't mean that it can't become more stretched. But when we look at other aspects here, this is a ratio of margin debt versus the S&P. On this basis, we are higher than where we were in 2008, and we're way higher than we were even in 2000. So And if we just say, okay, let's net out the margin. Some people are on margin, some people have a little bit of cash in their accounts. What does that look like? On that basis, we're at one of the worst places in history. And we see money-losing IPOs. Why are we seeing them now? Because all of the private equities, all of the people that invested in the market at the bottom, they're ready to sell. So who's buying? The public is buying IPOs, 83% of which don't make any money, and compared to January of 2000, 84%. So this is another measure of sentiment of public interest in companies that don't make any money and perhaps never will. Housing, let's look at originations, let's look at prices, let's look at cash purchases, student debt, and what's going to happen here. This is the key one down here, household formation. I was reading something just a few days ago talking about pent-up demand for housing, how much pent-up demand there is. And so let's explore pent-up demand. Here we have monthly origination volume. This chart came from Black Knight Financial Services. And I don't think it's the lowest on record, but it's the lowest that they've recorded going back to, what, 1997, I guess. And originations are plunging. Well, why is that? Home prices have flattened out. We had something like 40% of the home purchases in the last year, 43% I think, were all cash purchases. So you had the Fed-induced bubble, a demand for people going out there to buy houses for investment purposes. Well, how that's going to work? Who are they going to sell these things to? Here's a chart of prime housing demand. This comes from the Fed. Probably a few of you have ever seen this chart. I just actually found it about a week ago, and I said, look at this. This is kind of interesting. The net percentage of domestic banks tightening standards for prime mortgage loans. It's right there, right there. About 1% of banks are tightening their standards for prime loans, yet we see demand, in spite of minuscule tightening, plunging. Here's some percentages. I put this on a separate chart so we could look at them. The net percentage of domestic banks reporting stronger demand for non-traditional loans is 45.7. For prime loans is down 28.2. There's a chart that the Fed put out for subprime. Unfortunately, there was a gap in the middle of the chart, like missing the last year and a half. But if we look at current demand, the demand for subprime loans is the only place where demand is up for homes. So how is that going to work out? The number of new homes sold. This is a number that came out a couple weeks ago. 384,000. So when you see charts in terms of percentage terms, this was a huge rise. And you look at where we were in July of 2005, and you look at where we are now, 384,000 versus 1.39 million. So people look at this and they think this represent pent-up demand. How much of that was just oversupply that's taking this long to work out? Now, 30-year rates of mortgage rates. On May 2nd, 2013, you could get a 30-year mortgage at 3.35%. I don't know what it is today, but on April 10th, I produced this chart, and it was 4.34. Almost a 100 basis point rise in the price of a mortgage. At the same time, home prices have recovered. So homes are less affordable because the price has gone up, and they're less affordable because the mortgage rate has gone up. And people still think that the Fed is going to keep tightening, which, if they do, should cause those mortgage rates to rise. I'm with Steen on this one. People think that housing is going to provide a positive return to GDP this year. I think housing is a rock-solid bet to be a negative contributor to GDP this year. Let's take a look a little bit about demographics here. This isn't from today, unfortunately. It would look, I don't know, it would pretty much look the same. The only rise in employment since the recovery has been employment of those 55 years and older. 20 to 24 is flat, 16 to 19 is down, 25 to 54. We saw a decline and a flattening. Oh, who is it that's going to be buying houses? Is it this group? Or is it this group? So I don't see a lot of pent-up demand here for people unless this demographic here is going to change, and I don't see what's going to make that change. So here's an interesting chart that I put together. It's employed versus not employed. Now, not employed does not mean unemployed. Not employed, the way I calculated this is I took the civilian non-institutional population and subtracted the number of people employed from it. And in 2007, we had 85 million, 86 million, and the employment level was 147 million. Now we have employed 145 million. We've actually lost 2 million employment since 2007. At the same time, the number of people not employed rose by 16 million. Does that indicate any kind of demand for housing? And if so, where? It does show a demand for all kinds of excess services. It shows demand for food stamps, and you can see it in the rising number of people on food stamps. You can see it in the number of people on disability, which keeps going up every year. You can see it in terms of retirement, but people retiring, especially public workers, they're expecting their pension to be there, and they're expecting that pension to grow, compound at 8% a year. Well, how likely is that? If you believe John and Mabane and I, well, a stock market is going to have 0% returns on average for the next 7 years. So yet we've got an assumption that all these people here can retire or not be in the market and have that market grow at 16% a year. How likely is that? Now, I put a ratio of the employed to the not employed, and we saw women entering the workforce here, and as a result of women entering the workforce, people could take on more debt, and they did take on more debt, and they built larger and larger houses. Well, what's happening now? As a result of boomer retirement and as a result of the recession, we're back from 1.8 to 1.42, a ratio of employed to not employed. Yet the demand for medical care is increasing. The expectation for pensions is increasing. The number of people retiring that are going to need to draw on their stock market at a time when those returns aren't going to come in, I don't think that this says a lot for the demand for housing. Student debt. This is truly amazing here. Are these kids going to be buying houses? They're going to be starting families? What kind of family formation are we going to have here? Student debt. This is just government student debt, which is only about half of it. I don't have a good source for private student debt, but take this number here and double it. It's about 1.4 trillion are the numbers that I've seen. I can't come up with a Fred chart because the government's not tracking that. But take this. So we got 1.4 trillion in student debt. Are those kids going to be buying houses? Are they going to start families? Here's some interesting inflation comparisons. I asked Doug Short about a year ago for this chart, and then I wrote him about a week ago, and I said, can you update this thing for me? Well, here's college tuition and fees. What did I do here? Look at the percentage increase here of the cost of tuition versus the next big place where government's meddling, which is medical care, versus over to something of a cost of a new car. If you looked at technology, it would be going down like this. So wherever the government's meddled in the markets, we've seen the biggest rise. And with all the home affordable programs, with all of the Bush's, what did he call that? The ownership society, with credit creation, with the mandates on banks to lend to poorer areas. We saw a flood of people pour into, assets at exactly the worst time. And with home prices up again, I think we've kind of learned our lesson. So, where does this say that home ownership is going? And it's not just home ownership. When you buy a home, you buy furniture for it, you buy carpet for it, all the workers, all the trades, the tile, grass seed, landscaping, planning. So we don't have people starting families. We saw private equity come in and buy up, 42% of all the homes. They're not going to be fixing that stuff up the same way that a homeowner would, and not for as long. So that's another reason these expectations. This is real income growth. I got this from Doug Short, and I called him up actually just a few days ago. I said, Doug, so this is real growth, and this is nominal growth. So look at median wages. And I asked him to extrapolate this back. How far ago would this go to make this number here be zero? Real median wages are back at level of 1969. Half of the people aren't making any more than they were in terms of real income than they were then. That's if you believe. That's if you believe that the CPI is an accurate measure of inflation. What about housing prices? They didn't exactly follow that. When the Fed doesn't track home prices, they track they track rent. Owner's equivalent rent, they call it. And one of the ways they determine owner's equivalent rent is they ask people what price would they rent the house from themselves if they rented their own house. It's kind of ridiculous, but that is the biggest component of the CPI is an estimate of what people would rent houses from themselves if they rented their own house. Let's look at the rise in marriage age. For men, it's gone from, in 1960, from about 23 to 29, and women from about 20 to 26 and a half or so, 27. Do we see a lot of family formation? What's the trend here in family formation, if not down? And the number of kids people are having is down. People can't afford kids. So what does that mean, that they're going to be buying purchases for their family, clothes and the like? That's not a positive demographic factor. This chart here, the next one's more shocking, but I just stumbled on this. I was looking around. This chart actually comes from the Census Bureau. There's a lot of stuff out there that the government puts out if you just know how to look or find it. And I stumbled across this chart. And, look at this. The percentage of adults 18 to 24 that are still living with their parents. This is the trend from 1960 to 2013. The trend was this way from 1990 to about 2005. And, all of a sudden it's going, well, it's starting to decline a little bit here for men, but women it's still going up. But the next one's even more shocking. This is adults 25 to 34 who are still living with their parents. We've gone from, women was, what is this, about 7% maybe, and men about 12. So 19% of people, 25 to 34, were living with their parents in 2005. Now we have, what is that, about 12% of women and about 17% of men. Almost 30% of kids aged 25 to 34 are still living with their parents. Isn't that quite phenomenal? Are these people supposed to be out there buying houses? Does this represent pent-up buying? Or does this recommend, or does this look like a lack of jobs or overburdened with student debt? These kids have an attitude. They've grown up here in an attitude. They've seen their parents get into trouble with debt. They don't want any part of it. They're trying to avoid that. There's a huge shift in sentiment away from the problems that these kids saw their parents get into. They don't want any part of that. So things that, are expensive. This is today's S&P is one of the highest valuations in history. So if you're going to invest in something, do you want to invest in something that's one of the most expensive of all times, or do you want to search for things that are inexpensive? Now, Mabane Faber gave a beautiful presentation on saying, you need to look outside of conventional investments. You need to look outside the U.S. You need to avoid things that are expensive and find things that are out of favor or inexpensive. And here's a chart they put together of something that I think is cheap. And this is the price of the Huey, which is the gold miners index, divided by the price of gold. And on this basis, it is as cheap as it was back in 2001. And what a great buy that was there. Now, we have expenses of these mining companies, of course, has gone up, but also so is the price of gold. So where are we going from here? Is this a cheap asset or is this an expensive one? It's only expensive if you think the price of gold is going to plunge from here. Now, maybe I'm wrong, but I don't think the price of gold is going to plunge. I think it has, and the sentiment is already, weighed on that. So here's the Gold Corp price to book. It's now trading right at book value, pretty much. Now, a couple of years ago, we were actually lightening up on metals when Gold Corp got to almost, where is it here? Right there. And Newmont Mining got to a price to book a couple of years back at 2.53. Now, Newmont Mining is trading at 1.2. So, can it get cheaper? Sure it can. But does this represent a relatively good time to be buying this? You can only come up with an answer of no if you think that the price of gold is going to plunge. Here's an interesting look at the yield curve. I put this out. I do this post occasionally on my blog. I say Curve Watchers Anonymous reports. And I've had a couple of people say, who in the hell is Curve Watchers Anonymous? I'm searching for this term and I can't find it. And I said, Curve Watchers Anonymous is me. And so here's a chart that Curve Watchers Anonymous puts out. And it's in green, we have the 30-year long bond. In orange, we have the 10-year Treasury. In blue, we got the 5-year Treasury. And in brown here at the bottom, oops. And in brown, here we are where the Fed is held since late 2008, interest rates at 0.25%. But an interesting thing happened here. When the Fed first started to hike in 2004, this is what the short end did. This is what the long end did. Yeah. The 5-year rose, this rose, 10-year was relatively flat. The 30-year note came down. And let's flash forward here to today. Now, the Fed is announcing all these like intents to price. People think they're going to hike. We've seen the 5-year go from, I think it touched down in here. These are monthly closes, so you won't see the price as low as it got, which I think was around 50 basis points. So the 5-year since early 2013 has risen from 50 basis points all the way up here to 1.71. Meanwhile, the long bond, well, it's risen since then, but the long bond all of a sudden is saying, what happens if the Fed starts tightening here? This, I believe, in a zero interest rate environment, is as close to a recession signal as you get. They're still pinning this, so we're not going to see the inverted yield curve that we saw back here in mid-2006 and again in 2007. We're not going to see this yield curve invert. I suppose it would be possible for the 5 and the 10 to invert or something like that. But what this chart is saying is the bond market somehow doesn't believe the growth picture that all the economists out there are telling you that's going to happen. I have a tendency here to think the bond market has this right. So I actually think that there's another buying opportunity here in the long bond. I'm not sure how long it lasts, how low it goes. I don't have a price target on this like Steen did. I don't know whether we make another record low close or not, or in what time frame. I'm inclined to think that this weakness lasts a lot longer than 3/4 of a year or the end of this year, but that's just a guess. What I look here is what everyone believes. Everyone seems to believe this story that the Fed's going to be hiking, and I believe that if they do, they're going to cause a recession. Actually, a recession might be baked in the cake anyway, just on the basis of what's happening in the housing market. So my trading ideas and investments is invest in things that are cheap and out of favor. I like U.S. Treasuries. I like Japanese equities. I like gold. I say to avoid or even consider shorting things that are expensive. And right now, one of the most expensive things out there that I can find is the Russell 2000. I actually recently bought some puts on the Russell 2000. Now, a year ago, I was saying, you know what, I think we're at the top, but fortunately, I didn't go out there and say, short anything. Today, I'm going to say, consider shorting the Russell. There you go.
Any questions for Mish? Yeah, go ahead.
It's my first time here, so this is kind of an observation, but I suspect there's a fair amount of bears in the room, or probably wouldn't be here.
Hopefully they're not hungry.
No, the attendance is down from last year, and we were reflecting that was a measure of sentiment, actually, and I think it is.
Right. So, as I think about what's rolling around my head, and I missed you in your comments, I'm going to get to my questions, but I want to make a few observations about all the speakers that we've heard, which have been great. Is that there's this possibility that for those of us that are thinking '09 was not the low, the final low, maybe it's not the valuation low, but the price low, this possibility that Dean's putting out there for us that maybe it's a 30% correction and that's all we get. It seems like that is possible and perhaps probable without some other shock scenario. So I'm thinking, what's the possible shock scenarios? ECB needs to come apart, currency-wise. Japan needs to, hyperinflate, whatever. But anyway, do you have any specific comments or thoughts that kind of give you convictions, in addition to all your good charts, that this is on the horizon and is likely to happen?
So the question, if to repeat, is specific catalysts on the horizon for a decline in the market beyond valuation.
I don't know that we see anything lower than a 30% or maybe a 40% correction. I would think that's what it would take actually to get back to fair valuation. The normal tendency is to overshoot, but let's say we don't overshoot. Then what happens at the end of that 30%? Do we just go back to this normal presumed growth pattern where historically things rise 6% a year, or is our time frame too short for that to happen? So we're judging things on the basis of not only some of the largest financial experiments in the entire history of the world, but also a demographic boom, the likes that we've never seen. And certainly, Japan was out of sync with the rest. But, what happens in an energy constrained world, which is one of the things that Chris was talking about, and what happens when people are trying to live off their investments and cash out of the stock market to support their lifestyles? What does that say? So I think it's possible that perhaps even likely, but you mentioned the key thing in there, a low on a price basis versus a low on a valuation basis. When you start taking inflation into consideration and looking at some of those kinds of things, we can actually have earnings go up and the stock market go down. It's certainly not the widely held belief today that is even remotely possible. Yet it's happened before several times. It happened in the 70s. So where earnings are going up, but people are sentiment is such that people are more negative. They're demanding more return than they're getting. So from a valuation standpoint, we can just go down that 30% and then just meander there for, my gosh, a decade, John? Why not? And then, the next bull market starts. Or it could be 2 years or not. We don't know. We're guessing what the Fed's going to do. We don't know what the Bank of Japan's going to do. But we can see all of the tensions out there. We can see tensions between China and Japan heating up. Is it inconceivable that they start a war over the, how do you pronounce the islands, Senkaku? The islands over there, these barren islands that they're fighting for. Why are they fighting for it? Well, they're fighting for the mineral rights because of the oil that's in the East and South China Sea. So all of these tensions are over oil. And, unless something happens in a time frame faster than, say, Chris and I think is remotely possible, where fusion would come by and be readily available and ease those tensions, I just don't see the catalyst that others see, that we're just going to go down 30% and then everything's going to be wildly bullish. It could play out that way, but we can go down flatline, have earnings growth catch back up to valuations to the point where stocks are undervalued, and it's the following decade where everyone's out of favor. And I actually think something like that is even more likely. Everyone now is convinced of this long-term buy and hold model that's really been wrong. I think at the very bottom, people are going to be shunning long-term buy and hold right at the time when the market bottoms, and it will be the time to long-term buy and hold when the theory will be then thoroughly discredited.
I had a question. I'm getting a little suspicious of aggregate statistics, such as the ones that you trade today. Because I really think that, as someone said earlier, we live in this bifurcated world, and that we have a population where the bottom 25% may be doing terribly, and maybe doing worse and worse and worse and worse, where the top 75% do better and better and better and better, and make up 100% of the housing demand.
Oh, but that's not what's happening. It's the top 1/10 of 1% that's gaining most of the income inequality distribution problem that they're saying. The top 1% is doing very well. The top 5% is doing good, and it's actually the bottom 95% if you look at it in terms of that. But the way they're attacking this problem is all wrong. The Fed wants, and people are clamoring for more of the same policies that are actually causing the wealth distribution problem that we see. The Fed is the biggest problem behind this, and governments are the next biggest problem, behind this. They're actually causing this, and they say, well, how do we want to fight it? Well, they want to fight it by doing things that are unproductive. They want to raise the minimum wage. But what does that do? You raise the minimum wage enough, you give incentives to corporations to look for ways to not hire people. You make it easy for corporations to make a decision. Like J.C. Penney said, we're going to get rid of all of our tellers and go to total, self-service checkout. So we have these two contradictory forces, and that's why I think we're not seeing it in prices. We're seeing this asset inflation. Well, who is that benefiting? It's benefiting those that have the assets. Who has the assets? It's not the top 75% or the top 25%. It's the top 5%, 1%.
So if we have the Greenspan put, and then we have the Bernanke put, do we have a Yellen put?
I think we've seen it so far. The question is, when do these puts break down? The Bernanke put certainly broke down in 2008, right? And yet people think that it can't happen again. There is one difference this time, and I hate saying it's different, but what's different now, and the one thing Bernanke did, actually two things Bernanke did. John's pointed out one a couple of times. That's the accounting rule change that says, we're just going to suspend mark-to-market accounting here until we feel like doing it again. But the other thing they did, the Fed actually reignited the corporate bond market. Now, I don't think they realized that they created a bubble in it, but look at all of this cash on the balance sheets of corporations. When do they have to roll this over? And I wish I knew the maturity, because I asked someone today, what is the maturity? John, do you know?
I think the weighted average is over 8 years, but it's clumpy, which actually makes a little bit of a problem for just rolling it off, because it will have to roll off in clumps of maturities, and it's not smoothly distributed over.
And what happens to the earnings of corporations if they decide to roll this debt over and they're not doing it at 50 basis points? IBM, a couple of years ago.
Oh, I thought you meant the Fed.
No, not the Fed. I'm talking about the
corporate maturities are shorter. I don't exactly know the numbers, but they tend to cluster when they're issued in the 3 to 5 range.
Okay, so they're issued in the 3 to 5 range.
Those are already getting shorter.
IBM was borrowing money at 0.5%. Now, the 5-year rate is 1.6%, something like that.
Yeah.
So what does that do to the earnings of IBM when they've got to roll this debt over at rates that are getting higher and higher? So these are the kinds of forces that are at play. If we see the inflation unleashed that Steen thinks is coming, that I don't, it's going to get even worse, because investors are just going to demand even more than what's priced in here at the low end of the curve. I don't think they're going to be going out there borrowing money at, for 30 years. Essentially, corporations were borrowing money they didn't need just to make sure they had it to get through another credit crunch. Now, what if they decide not to roll that over and we have another credit crunch? There's all kinds of things that can happen, but none of them look any good to me, because if these corporate bond rates are going up, not a lot good is going to happen out of the stock market as a result of that.
So we're going to bring Chris and Steen back up here, and Mish, you'll stay, and we'll keep the questions coming. So come on up, guys, and I'll pull some chairs.